Hello guys, welcome once again to another lesson of the trading program. Now this is a lesson 5, which will be focusing on order types. Now at the end of this lesson you will understand all order types, know when to use each, understand precision entries, place trades professionally. Now in Forex trading, entering the market is not random. Actually, we don't enter the Forex market randomly. Professional traders choose how they enter based on strategy, timing, and precision. There are 3 primary order types used in all markets. Now, we have the market order, we have the limit order, we have the stop order. Understanding when to use each is essential for precise execution. Before we enter a market, we should be able to define our risk. We should be able to time the market to know the price we are willing to buy the asset or we are willing to sell the asset for. It's like as a business owner, you don't just sell at any price. You sell at a particular price and you buy at a particular price. So that is no different for the Forex market. You have to know when to buy a currency pair and you have to know when to sell the currency pair, and you have to do that at a specific price that you want to buy at and at a specific price that you want to sell it at, so that you can make the kind of profit you want to make. Now let's move on to the market order. Market order. A market order is an instant entry. Now, a market order enters a trade immediately at the current available price. Now, if you are clicking a buy or sell, you are using a market order. Now, the moment you click a buy or sell on the trading platform or your brokerage or your third-party trade placing app or software, the moment you click buy or sell, you are entering the market or you are executing a trade instantly. That is what we call market execution, regardless of the price. Now, these are the characteristics: no price control, subject to spread and slippage, used when entry timing is agent. Now, we use it when we want to enter a trade agently. For example, if you sleep and wake up and then you realize that the trade or the price have gotten to the level or to the price at which you were willing to buy, but you weren't available or you didn't place a buy limit or a sell limit at that price, and then you don't want the price to move without you, you use market order, which activates an order instantly at a given price. Now, for this example, let's say you are trading on the euro US dollar currency pair. Now, the current price is at this 1.1 dollar per 1.1 euro per dollar. Now, you press the buy entry. You press the buy entry at this price, but the execution is executed at this price with 1 pip increment. Now, this is due to slippage. That is what we say, subject to spread and slippage. Slippage is when you want to enter the market immediately at a price. Let's say you want to enter the market at a price of let's say $1.1, but At the time of execution, the price moves to $1.2. That is what we call slippage. So the difference, the $1, the 0.1 difference is slippage. That is why we say market execution is subject to slippage. Now let's move on to the limit order. Now with the limit orders, the limit order enters at a more favorable price than current market price. Professional traders prefer limit orders because they allow precision and better risk reward. Now we have two types. We have the buy limit and we have the sell limit. Now the buy limit enters below current price and the sell limit enters above current price. Now buy limit, if you expect price to drop first then rise. Current price at 1.1 per a currency, you place a buy limit at 0.098. Trade triggers only if price retraces down for pullbacks, support zones, demand zones, or discount entries. And then we have the sell limit, which you expect price to rise first then fall. Current price at 1.1, then you place a sell limit at 1.1020. Trade triggers on retracement up for resistance, supply zones, or premium entries. Now these limit orders are very, in my opinion, good for executing trades. Now let's say you want to enter into a market and the market has a resistance and a support. Now the market moves from here up into this level, and then you realize that there is an FVG here. Then price break above the resistance, trace back, trace down, then you place a sell limit at this level. Sell limit, place a sell order limit at this level. Then price returns back to that inverted FVG and sell off to take out this sell side liquidity. Now from this level to this level, you are making profit. That is what a limit order means. Now the same thing goes for a buy limit. If the price goes and then breaks above, if price breaks above, trace back down into the zone, takes out this liquidity, comes back up, then you trade this place at your FVG, place a buy limit order here. When price reverses back into it, you are in the trade, then the price take you to take out this liquidity. This is how we use the limit orders. Now you can be sleeping or you can be somewhere doing your work, but the trade will be going on. So in this case, you can either place your stop loss here or you place it here. Then you place your take profit at this level. So TP and then SL. We'll be learning about all this thing very soon. So now let's move on to the next. Now the next other types are stop orders. Now stop orders are entered at breakouts. Now a stop order enters only if price breaks a level. Now we have two types. Again, as usual, we have our buy stop and our sell stop. Now, the buy stop is placed above current price and sell stop is placed below current price. We use these orders when momentum confirmation is required. Now, buy stop, if a current price is at this level, $1.18, and then you place a buy stop at this level, $1.102. Now, trade activate if price breaks upwards. Now, we use it for breakouts, we use it for trend continuation, and we use it for high breaks. Now, breakouts, trend continuation, and then high breaks. Now, sell stop, for an example, is used when we want to place a current price at this level, then we place our sell stop at this level. Now, if price moves down, it triggers the breakdown, then we use for breakdown, and then trend continuation or low breaks. Now, this is what it means. Let's do some drawing to understand what it actually means. Now, if we have our support here, then we have our resistance, then we have price moving sideways into it, moving this way. Now, in this one, we have let's say we have a very complex diagram this time around. Let's make it too complex. So this resistance and support, then price moves from here to this level, comes back into this level. Now, if you want to place a buy stop, this is where you place your buy stop, at this level. Buy stop, let's say BS, buy stop, and this is sell stop. This means that you are basically saying that if price breaks this level, this resistance level, the price will continue to a certain price, rising price. So the moment the price breaks this level, immediately you are in the trade and your stop loss will be below here. Then automatically you are in the trade. Now, this is what the sell stop also means. If price breaks down, your sell stop at this level will be triggered, and then your anticipation is that price will keep dropping lower, then your stop loss will be at this level. This is what the buy stop and then the sell stop means. Now you are saying that if the price breaks upward, it will continue going up. That is for the buy stop. And then the sell stop, you are basically saying that if the price breaks low, it is going to continue dropping lower. And then that is just all for the buy stop and then the sell stop. Now let's move to the next lesson. Let's move to the next lesson. Now we are moving to why professionals prefer limit orders. Now, limit orders provide better entry price, smaller stop loss, high risk reward, precision at zones. Now, this is the main reason why we use limit orders. Now we enter at high entry at better price. We have smaller stop loss, then we have high risk to reward, then we have precision zones. There are some zones on the chart which are precision zones. Now, as a forex trader, a retail forex trader, you are trading with the banks, institutions, hedge funds, people who trade billions of dollars. So your only duty is to find where they are actively placing trades. If they are placing a buy trade at a certain level, you are also placing a buy trade at that level. If they are placing a sell trade, you're also placing a sell trade, and you join the trend with them. Now this is an example. Now we have a market entry at this, then SL at 50 pips. This is a market entry. You entered at this level, then your stop loss is at this. Now this is a limit order. Your entry it as this, and then your SL at this. Now same idea but less risks. Now let's move to the next aspect. Now we have order placement logic. Now professionals use limit orders for pullback, and then stop orders for breakouts. Now trend traders use actually that way of trading. Now we have range traders as well. Now range traders, high is equal to sell limit, and then low is equal to buy limit. Now scalp traders often use market execution. Swing traders use limit orders often. Now precision entries. Precision entry means entering at support or resistance, at supply or demand, at liquidity zones. Take note of this. Liquidity zones. We'll be talking about it more often on this channel. Now at retracement levels, limit orders allow this, market orders do not. Now limit orders allow you to enter at support or resistance immediately, supply or demand immediately, at liquidity zones where liquidity are taken. The liquidities will be taken, but you'll be activated into the trade at retracement level. But market orders does not allow that, because you are placing the order instantly, which will be executed instantly. Now we move to the last aspect, or let's talk about this aspect as well. Now we have the order type compression. Now with the market order, location versus price. Now the market order opens a trade at the current price with a slight slippage. It's instant. Now buy limit opens below, then it allows you to enter on a retracement. Sell open above allows you to enter at retracement. Buy stop above allow you to enter on a breakout. Sell stop below allows you to enter at a break sell. Now real trading examples. Let's look at these real trading examples. Now scenario 1, pullback buy. This is scenario 1. Now we have an uptrend. In an uptrend, we have retraces, and those retraces are buy limit. Now scenario 2, we have breakout. Now resistance break, buy stop. If a resistance is broken, you are buying. Now scenario 3, we have reversals. Resistance, sell, which is a sell limit. So if a market approaches resistance, you are actually saying the trade should be executed as a sell if you are not around. Now the core professional principles. This is what separates real traders from beginner traders. Now amateur traders or new traders or beginner traders are, now professionals let price come to them. This is why limit orders dominate institutional trading, but amateur chase price. Now beginner traders always think that price is moving and leaving them. The moment they see that there's a resistance and there's a support here, and then they see that the price have moved to this from this level and then it's moving up, you see that they will be rushing to enter, probably enter at this level, enter at this level, and then all of a sudden you see price move this way and then retrace back into an order block here. By that time they are already out at this level because their account is gone, their account is blown. But a professional trader will place a limit order at this level. A professional trader will place a limit order there, or probably at this level. Now when the price traces back to that level, it will be executed, and then they will be part of the trade, and then to continue moving. But beginner traders are always rushing to get into the trade. That is why they are always removed from the trade before it even starts moving. So thank you for going through this program. I know that you have actually understood the other types and how to use each of them. You understood how to enter precisely and place trades professionally. So this is just a recap: a market order, limit order, stop order. These are the orders we have on the marketplace. Thank you very much for watching. Please do well and subscribe to this YouTube channel. Thank you. Have a great day. See you on the next lesson.